Hello and welcome to this section 1.3. We're completing part A of module 1 here. And my first question is, you want to buy a house. Maybe you're newly married, or you've got engaged, or you've just had your first child and you're buying it in Melbourne. You need to find $1 million. It sounds very much like Austin Powers for those of you who can remember the 90s. So look, you don't have to find the whole million. You might have saved $100,000, $50,000. But what do you do? So if the average salary in Australia at the moment is about $60,000 to $65,000. So even if there's two of you working, that's $130,000. Let's not even worry about tax. And the average Australian hasn't got very much savings. 1/3 of Australians have zero savings. So how do you buy a house? Well, in the normal or the traditional finance system, what we have on the left-hand side are our lenders. And on the right-hand side, we have our borrowers or our spenders. So these people need to borrow $1 million. But we also have some people who've managed to accumulate wealth over their lifetime. Maybe they're retired now and they want to get an investment return. Now, how do these people find each other so you can borrow a house? And the final question on the previous slide asked about what are the interest rates? Well, luckily at the moment, interest rates, you can borrow a little bit below 2%. So if you borrow $1 million, it sounds extraordinary, but you're only going to be paying $20,000 worth of interest, which is quite affordable for now. But don't forget, interest rates will go up over the next 5, 10, 15 years. So trauma will probably come in the future. So how do the lenders interact with the borrowers or the spenders? In the traditional system, we have what are called intermediaries. So groups such as banks, where the lenders put their money into, and then the banks go and find the borrowers. And the benefits of that is the lenders don't have to find the individual borrower that matches exactly. So a lender might only lend $3,000. And if you get 5,000 of those lenders, you have money to lend. And then the bank consolidates all of that and lends it to one borrower who can buy a house. So the power of intermediaries is extraordinary. And so we have direct funding and indirect funding. And if you look in the detailed figure in the study guide, you'll see that expanded on in more detail. But that's the point. The traditional system uses intermediaries to connect people so that they can borrow, or so they can spend, or so that they can invest and get a return. But some people are included in this system. And normally if you're middle class or upper class, life's easy. You go to the bank, you have credit cards, you have access to a wide range of resources. If you want to either grow your business, invest some funds, buy a house, whatever it might be, buy a new car, problems are easily solved. But for a lot of people, there is financial exclusion. They don't have access to a bank. They often don't have access to things like electricity or running water. So what do they do? So what's pretty exciting, and this actually goes back 11 years, but in a country like Fiji, where 70% of people didn't have a bank account, what they did was they used the mobile phone network to transfer money and cash to effectively create these electronic wallets. So these concepts you're reading about in digital finance have been around at least a decade. The bits I love about this is this type of innovation didn't happen in places like Australia. It didn't need to. People had banks, people had credit cards. This kind of innovation had to happen in a country where people were unbanked. And so developing countries effectively leapfrogged into this system in the same way that a lot of developing countries don't have landlines. They leapt straight onto the mobile platforms. So they didn't have to spend on landline type infrastructure. So what's really exciting about this, and this article, like I said, 11 years old, you load the money onto an electronic wallet. You top up your phone, you transfer, you pay bills, you withdraw cash. You can do all of these things. And all you needed was a simple Nokia. You didn't need a smartphone or anything like that. And that's very exciting. So what happens is we are breaking down these old systems in the traditional financing network. Now, another example where we break down the need for a major bank or these formalized intermediaries is peer-to-peer lending. And so normally lenders pull their funds with the financial institutions who then send it off to the borrowers. But if you can connect the two, then magic can happen. Now, this is discussed in more detail in Module 2, so just introducing it. But what's great about this is if you can connect your lender-borrower, which has always been the difficult task in the past, then the transactions can happen more smoothly. But keep in mind, the lender can be taking on a lot more risk because they're lending to one. What if it's not verified? And there are examples of peer-to-peer lending going badly. But this is a great example of transformation in the financial system. Disintermediation is one of the technical terms there. So, Fintech 1.0. Earlier on in a previous clip, we looked at the idea of Industry 4.0. Now we're up to Fintech 1.0 and Fintech 2.0. It's very cool ways of talking about stuff. I actually find a little bit awkward and a little bit cheesy, but here it is. So originally, things like payment processing started happening, 2010 to 2014 lending models, like what I've talked about before. Incredibly powerful and transformational. Now, Fintech 2.0, we're seeing banks who used to do none of this, and Fintech who used to come and be the upstart kicking down the door, working together. Because the banks do have decades of knowledge and systems and infrastructure and process. But we're also moving to more open financial structures where data is shared much more effectively with things like APIs. So open banking, this is coming, and once again discussed in much more detail in later modules, but just introduced in Module 1. Open banking went live last year, July 2020. So what does that even mean? So open banking opens up banking data and how it can be used. More specifically, bank customers can give permission to third parties to access savings and credit card data. Now, initially, you might think that's terrifying. Why would I do that? And then on the 1st of November, accredited parties could even get your mortgage, personal loan, and joint bank account data. This can be really useful. Why? Well, it means that if your data is already in place, if you apply for somewhere new, start from the beginning. I don't know if you've ever done a rental application for a house, but the same thing happens. If you apply for 10 houses, it gets very tiring filling in the details 10 times in a row. So you complete the data once, and then it's just shared. It just takes place. So you should be able to get a loan more easily. You should be able to sign up for your credit cards or debit cards because your banking history is there, your pay slips are there. Everyone can look and check. Budgeting tools that integrate. You can switch. Now, those are the benefits. Interestingly, the website isn't as loud and clear about the potential risks. Now, if your banking data and your personal credit risk is going well, that's fine. But what happens if you have financial distress or financial issues? This is where problems can arise. So do you really want everyone knowing your intimate details? A similar issue arises in places like healthcare. It's fabulous to have healthcare digitized and easily sharing that data around if it's medical people doing the right thing. But in the hands of the wrong people, someone who wants to exploit you, blackmail you, an insurer who wants to refuse to look after you, that's when it's problematic. So that's the concept of open banking. That brings us to the end of Module 1, Part 8. Once again, we always encourage you to reflect on the objectives that you've been studying towards, because this is how you'll be examined, and think about how it pieces and ties together. Thank you.